There's a lot of reasons that real estate makes for a great investment vehicle, especially in the United States. You obviously have the cash flow. You have the fact that it can be passive. You can make money while you sleep. You can also do things like depreciate the asset to get the tax benefits. And of course, it's a physical asset, which means that it's inflation resistant. Right? You can raise rents and therefore basically balances out whatever's happening in inflation. Now, there's another component of this, though, which is that there's always an opportunity in real estate. And the reason for this is that the asset class itself goes in cycles. You have the economy that's going in cycle. The capital markets are expanding and contracting always. So that means there's always an opportunity depending on where you are in the cycle. But also, in part because of that, the real estate market itself does a little bit of expanding and contracting because of the fact that you can develop properties. So in a typical cycle, as it gets closer to being overheated and as rents are really high, then it becomes very advantageous for developers to come in and develop new units. And when developers do this, as has been said on my podcast before, developers are a little bit like cowboys. So they tend to overdevelop. And then you have all this supply come online at the same time because all developers are seeing the same signs at the same time. They all hit the green light at the same time. And then when this development comes online, you usually see a drop in occupancy rates. And then there's this time period where that occupancy needs to be filled up. Those vacant units need to be filled up. And this is kind of the nature of real estate. This is why if you have a diversified approach from a risk profile standpoint, you can always be involved in the sector because there's always an opportunity, whether it's buying stabilized assets that developers were able to get filled up, or you can buy value add assets that developers overbuilt. And now there's a massive opportunity to go from 60% occupied to 90% occupied, for example. And by the way, this is especially the case in self-storage. It's an incredible vehicle, and it's been through a lot of these cycles, despite the fact that it's relatively new asset class. During these cycles, it tends to hold up very well because of the fact that it's a great investment vehicle. It's a simplistic asset class from a structural standpoint. It can be very complicated from a business and operational standpoint. However, this is not the case with mobile home parks. So with mobile home parks, because most of them are built in the 60s and the 70s, mostly as a veterans housing project, they haven't really been developing since then. And so what's interesting about this is that you don't have this natural cycle that takes place. Now, you do have the economic cycle, the capital markets and such, and the whole perspective on the asset class, which has changed significantly since the 70s. But you don't have the natural ebbs and flows typically that you would have in real estate because you don't have the development component. So when the properties were originally developed, it was kind of how the suburbs were invented. And originally, people thought of the suburbs as kind of nice areas. It was kind of a desirable way to live out your life. And that's changed a lot since then. So mobile home parks went from being something that was pretty desirable to now, something that's not very desirable. So what happened in the last run up is everyone's chasing yield, 2006 or so, 2007. Private equity groups go, oh gosh, we got to start buying mobile home parks. It's the only way to get a good yield. So that ends up happening. There's not enough liquidity in the market. People need to refinance. A lot of people have trouble refinancing despite the fact that there was cash flow there to pay off expenses. And some people lost properties. And that's when a lot of the companies that we work with started buying assets because the previous owners were completely over leveraged and they may have been cash flowing, but the values had changed significantly because the buyer pool shrunk significantly. It was already small to begin with. So my point is, now that the paradigm has shifted, now that people recognize that the mobile home park business is an incredible investment vehicle, what happens now? Because we've basically seen a significant cap rate compression, more so almost than any other asset class, right? We saw cap rates in the 12s in 2010. Now we're seeing cap rates in the 6s. And normal properties, 3-star parks going for 6% cap rates, which I'm not mad at. I think it's perfectly reasonable given the other available opportunities out there and include everything, especially, international capital markets all over the world. United States real estate is a great bet. So now that paradigm has shifted, what happens now? Is the mobile home park play just over? Because we don't have the situation where you can have massive development, which will cause overdevelopment, which will cause high vacancy rates. You have this compression of cap rates. Now what's going on? What's the next stage in the mobile home park business? It's very interesting. I do think that the case can be made that we will likely see at least on par cap rates with apartments because of this reality. And you could even see an inversion. Typically, C-class, B-class apartments trade at lower cap rates than mobile home parks. But because of the fact that now the paradigm has shifted and now investors understand how desirable the asset class is, it's something really to contemplate. You also have this other component where most of the owners are mom and pop owners, single asset owners, a lot of baby boomers. So they're getting close to not only retiring, but many of them are dying. So what happens with a lot of our deal flow is that the owner will die, the daughter and the son will inherit the property, and the daughter and the son don't want to manage a mobile home park, and so they will sell to someone that knows what they're doing. So the question becomes, is now that someone that knows what they're doing is purchasing those assets and they're making a significant dent in the business, which is why you're seeing the change in cap rates. Now what? So the next 10 years are going to be very different than the current 10 years. Having said all that, if you're well positioned in the marketplace, if you already have an operating partner that has a significant market advantage, there's a case to be made that there's never been a better time to invest in the mobile home park business for a couple of reasons. Number one, the main challenge with the mobile home park business, as with any tertiary asset class, is that the buyer pool is smaller. Well, when you remove that risk, and now you have this incredible tenant base, this tenant base that actually owns the properties, 7 years, 5 years on average. Well, you got a great tenant base, you got a great high cash flowing asset, you have an asset that you can add significant value to quickly because it's 30-day leases. And now the buyer pool is extremely large, and therefore the debt pool is increased significantly. If you remove that risk component, you have a really special vehicle. So my point is, if you're working with a company that has a significant amount of operational expertise, and they have a huge market advantage because they're economies of scale or because their know-how and their experience in the business, it's an amazing time to be in the sector to see how this plays out. Because despite the fact that we've seen cap rate compression, it's very likely, I think, that we will see some more. And this is one of those things. It's hard to make the case that you can see that snapback in cap rates to, let's say, the 12s or whatever, because of that lack of development component. The paradigm has shifted, and people know now that the mobile home park business is an incredible vehicle. So it's interesting to think about, and this is something that I was talking to an investor about recently. So just wanted to share that with you. All right, hope you enjoyed these Monday Minutes. Have a great day. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy. Leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.